Trump's bombshell triggers market chaos, and it's about to set off a chain reaction in the economy. I'm Steve Van Metre. How it started is crushing markets, and it's about to crush the economy. This is just the start of what's to come. Stay tuned. Plus, our momentum trades of our subscribers flying high while markets burn. Want to profit in this chaos? Stay tuned to the end of the show, and I'll show you how. Now, let's head over to Bloomberg, where he picked today's story up on the headline. As Trump says the economy faces transition, avoids an all-out recession call. This caused the NASDAQ 100 to slump as much as 3% in early trading, and it's accelerated to the downside since then. And if you think back to after the election, many people bought into stocks and in a big way because they were looking for a repeat of Trump's first term where stocks and the economy took off. Now what we're finding out from his bombshell warning is we may not be at the beginning of an all-out bull market. We may be at the peak looking at the downside as the U.S. economy faces an all-out recession. Anxiety that tariffs and government firings will torpedo growth in the world's largest economy extended a 3-week stretch of volatility across global markets. And here's what I want to know from you. Are you panicking about what's happening in the markets? Hit the like button. Are you worried about your job? Drop a comment below, because this is all about the labor market, as you're going to see in a moment. Now, Wall Street has tempered its once bullish views as it turns bearish, and this has caused a big demand for recession havens, driving sovereign bond prices higher in the U.S. and Europe. Because when we talk about government firings, we look at the labor market, and what we can see going all the way back to the 1970s is when you have a slowdown in demand for labor, as we're seeing in the private sector. We've seen hours work get cut, we're seeing jobs lost, and then you tack on a large amount of job losses, such as what we're seeing from the government right now in terms of what DOGE is doing. What you start to find out is the U.S. economy is headed right into a recession, and that's exactly what we see on this chart. And I want you to hit the like button if you're upset about what's going on in the economy right now. Comment if you're on the verge of losing your job, because let's look at what happened in the 1970s. Let's see the unemployment rate in blue and continued claims in red. They both start to rise. We go right into a recession. That happens again in 1974. It happens in 81. You see it happen around 82. You see again in 1991. The labor market says we're headed right into a recession. So when we start to think about Trump's comment that more pain is likely coming, it's very evident when we see in the labor market that all the mass layoffs from the government are not going to help an ailing economy. You see around 2001, the labor market pushes us right into recession. Again, the global financial crisis started to fall apart, but it was the labor market that put the final nail in the economic coffin. And how about now? What we're facing is rising continued claims, a rising unemployment rate, and so a recession in the U.S. is now becoming a foregone conclusion. So when you look at the reaction in the equity markets today, what we're finding out is investors were completely mispositioned. They were bullish. They thought Trump was going to drive stocks higher. They thought the economy was going to boom. And what they're finding out is perhaps we're now headed right into a recession. And this may be only the beginning of what's coming for equity prices. As speculation is intensifying that Trump is willing to tolerate hardship in the economy and markets in pursuit of long-term goals involving tariffs and smaller governments. If you're frustrated, if you're angry, hit the like button. I want to know what you think of the economy. Drop a comment. Do you blame Biden? Do you blame Trump for what's going on? I want to know from you. Hit the comments. Let's hear your voice, because let's take a look at what's really affecting the economy. We can see this has been brewing for a while, and that finally Trump is admitting the truth that the U.S. economy is in a bad place and is going to get worse. As we now take a look at average weekly hours of production and non-supervisory employees, they're shown in blue against continued unemployment claims. So as we talk about the private sector slowing down, let's go back to the late 1980s, and what do we see? Employers are cutting hours, and then they start cutting jobs. We go right into a recession. Let's move forward to the late 90s. What do we find out? The economy starts to slow down. Employers start to cut hours. Then they cut jobs, right into a recession. And you can see this recipe happens right into the financial crisis, except they didn't cut hours that much before we are headed right into a recession as continued claims shot higher. In fact, looking at the pandemic, what do we see going into it? The economy was clearly slowing. Hours of work are getting cut. People are hitting the unemployment line. And now we can go all the way back to 2021 and we can see the trend where hours worked were on a decline. Continued claims responded, but employers said we're still looking to hang on to our employees, but it's unlikely that's going to last, particularly when you factor all the government employees about to hit the unemployment line. You could see this is going to quickly spiral out of control. And so from an economic perspective, we can look at what's happening right now and we can make a fairly good prediction we're heading into recession, and that's what the markets are starting to figure out today. He said the U.S. economy faces a period of transition, deflecting concerns about the risk of a cool down and his early focus on tariffs and federal job cuts that's causing market turmoil. And a period of transition, well, if you go from a period of expansion in your economy and then you're facing a period of transition, well, it's very clear what that means. Whether it's an all-out recession, a financial crisis, or even just a mild recession, what it means is the U.S. economy is slowing down. But the big problem here, it was already slowing down. And that's the real issue, because if it slows down even more, the odds of recession start to get high. And then you think about the other parts of the economy. What about commercial real estate? We've got a lot of empty buildings and a lot of regional banks exposed with risk. How about the subprime auto market? We're seeing delinquency rates rise. Again, you're seeing a lot of recipes for a financial crisis brewing here. Want to know what you think? Or you think we're headed just to a recession, a crisis, maybe something worse like a depression? Weigh in the comments, because Trump said there's a period of transition because what we're doing is very big. Now, you can make the case on anything that if you're willing to take some pain early on, that maybe the economy will turn around. Now, of course, we have no evidence. We don't know that that's going to happen. But yes, pain always does come first. And President Trump doubled down on the current policy path and acknowledged the chance of a slowdown. And that's weighing on sentiment, because when you hear a leader tell you the economy is slowing down, whether it's a president, somebody in Congress, or the Fed, well, everybody starts to pay attention because they start to believe there's something they don't know that you don't know. And that's what we're seeing the reaction of the market today. You see, why is everything dumping off? Because Wall Street bought into the narrative that many retail and institution investors did, that the economy was going to boom and you wanted to be in stocks. Now we're finding out from the most powerful man in the country that perhaps the U.S. economy isn't going to boom. The only question is, how far can it go down here? Want to know from you? Weigh in the comments what you think. But something that's headed up, that's our subscribers' accounts. And despite the chaos in the market, they're making money. We told them to take this trade right here. This is in Hong Kong equities. We told them to buy at the open right there, and it's shooting higher. How did we know that? Well, we looked at the momentum signals and we paired that with a rising trend. My friends, we recently revamped our Momentum Timer Pro Report, and it's driving some amazing trades. And you can get in on that too. Stay tuned to the end of the show, or check out the links in the description below. Be sure to use a coupon code for a free 30-day free trial. Markets continue to prove sensitive to trade policy as considerable uncertainty remains over the size and scope of tariffs to be implemented. Now, why does this matter? Why is this such an issue? Because we talked about this on Sunday's show. If the consumer price index goes up, the market's going to have a massive negative reaction to it, because the issue that every American household is facing right now is rising prices, slowing employment, slowing income. We're heading into stagflation. So the challenge here is, what is the likely outcome of tariffs? Is higher consumer prices. Now, we know American consumers can't already afford today's high prices, so what is it going to mean for consumption? It means demand likely to go down. Stocks really don't like that at all. But just as important may be how long the tariffs stay on. Are they temporary in order to extract concessions, or they a new permanent fixture in U.S. trade policy? And if you think about Wall Street's perspective, they thought it was temporary. They thought a lot of countries would run to the negotiating table and make concessions. What we're finding out is people want to fight and they want to stretch this out. The risk is this is going to be protracted. I warned you before. I said the U.S. economy wasn't immune to this. It would take a hit. And now people are starting to realize that the U.S. economy could plunge into an all-out recession. And let's take a look at some evidence supporting the slowdown in the economy that already began years ago and is now looking to accelerate to the downside. Because when we talk about consumers being unable to afford higher prices, there's a lot of evidence that. So when we think about tariffs driving prices even higher, well, it's a dangerous sign for the economy. As we look at the consumer price index in blue against total income of production and non-supervisory employees, this is multiplying average hourly earnings by average weekly hours. And keep in mind, Hours worked are decelerating. So let's go back to the late 1980s. Inflation surging higher, but rising prices are not passed on in wages. You see incomes peak, roll over, decelerate right into a recession. How about the late 1990s? What happens? Inflation on the rise, incomes get a little bit of a boost before they peak and head lower. Next thing you know, right into a recession. And again, it makes perfect sense because if incomes aren't rising with inflation, households cannot afford higher prices. They cut their spending, and it back feeds into the rest of the economy. How about we move forward around 2006? Inflation starts to take off due to rising energy prices. Incomes already peaked before decelerating right into a recession. And now what are we facing? Tariffs, higher output prices at the manufacturing level, higher services prices, a weaker dollar. Everything's saying in the short term inflation's heading higher. The risk is that households can't afford it. That means spending going to go down, and that is for the rest of the economy for a lot of other workers. That is not the news they want to hear. And we can see evidence of that very clearly, that it is about jobs. It's all about incomes. As we keep incomes in red, now overlaid against advanced retail sales, this inflation adjusted in blue, and we can see in early 2000s that deceleration in income matched perfectly with a deceleration in real retail sales, because it makes perfect sense that if incomes are not keeping pace with inflation, demand goes down, retail sales must go down as well. You can see that effect starting in 2006. Incomes peaked, they decelerate, retail sales responded in kind, and as incomes fell enough, it led to an all-out contraction in retail sales and the global financial crisis. Let's look what happened in early 2002. Income started to come down as pandemic stimulus faded from the economy. What happened? Real retail sales plunged straight down into negative territory, where they've stayed that way for largely the last 3 years. Incomes looking to head lower, particularly as the unemployment rate and continued claims head higher. That means retail sales to the downside. And from the factory's perspective, well, if sales are going down and inventories are building, new orders go down, and that means the need for factory workers go with it. Then you factor what's going on in the regional banks who are holding all this commercial real estate loans. You start to factor what's going on in the subprime auto market. You see delinquencies rising there. You see them rising on the consumer side, on the credit card. You find out the U.S. economy is not coming at this from a period of strength. It's coming at this from a period of weakness. And the issue isn't just that the U.S. economy is slowing down. The reality is the global economy is headed right into recession as China's inflation declines below zero for the first time in a year. So you start to think about this move. If you're going to engineer a recession, if you believe that's what the administration is doing, well, you want to do it during a time you can blame a lot of other people. And based on what we're seeing in China, is the global economy is indeed headed that way. As the consumer price index declines 0.7% from a year earlier as deflation takes hold in China. What is that telling you? Demand from Chinese consumers is down. There's another factor here, because if demand to China is going down from their consumers, what does that mean for the rest of the world? Remember, China is the world's largest exporter. Their demand comes from the world. Their workers make money. When the global economy is booming, they're clearly cutting their spending. Goldman notes a decline in services prices combined with a rare negative reading for core inflation were among symptoms of sluggish consumption. And we said this was coming for China. They tried to do a whole lot of stimulus and it didn't work. And we said it wasn't going to work because their economy is completely dependent on the rest of the world. And China's economy still faces deflationary pressure. Domestic demand remains weak. And finally, we're seeing some of these experts wake up to what I've been saying now for a while, that after all this pandemic stimulus, the economy booms. And now what we're seeing on a global basis is the economy come off that high as the stimulus is now gone. What you have is a massive correction in the economy. The problem is it could lead to a massive global recession, potentially financial crisis, because the country is on track for the longest streak of economy-wide price declines since the 1960s as a result of weak spending, while the property crash is yet to bottom out. So you think about China's perspective. They're slowing down now, and what's going to happen is the property sector could trigger an all-out financial crisis there. Again, we've warned about this, but you're seeing it happen in real time, my friends. Urgency has grown from the government to reflate the economy, but all attempts have failed. At the annual Parliament session on Wednesday, China announced an ambitious economic growth goal of about 5% for 2025, and there's absolutely no chance that that's going to happen because their economy isn't about stimulus. And yes, they can do it, and it's going to drive consumption for a little bit, but their economy is so dependent on the rest of the world that when the global economy slows down, all the stimulus in the world can't save China. And the producer price index declined 2.2% in February from a year earlier, slightly more than forecast. Again, deflation now coming from China's factory sector, meaning even if there were no tariffs coming, they're still going to export deflation. This is a massive warning for the global economy. And here you can see the U.S. consumer price index in blue against import prices from China. And you can see where input prices go, consumer prices here in the U.S. tend to follow. Now what China is saying, demand is so weak that import prices are going to roll over. They're going to export deflation. Now they're going to get tariff. We already know that. But what China's economy is telling us is the demand in the U.S. is weak. And that's what's making Trump's moves here very risky. Could plunge the U.S. economy not just into a mild recession, not just something that there's going to be a little bit of pain, but there could be a lot of pain coming. In strategy, see more S&P 500 and volatility as tariff fears kick in. Keep in mind for the markets, there's a lot of systematic programs out there. And then when volatility goes down, when stock prices rise, they're buying stocks. But here's the risk. The sell-off is just potentially the beginning. Because as volatility goes higher, well, these programs have to sell, and what they do is trigger other selling from other systematic programs. And at some point, not only do hedge funds start to sell and institutions start to sell, the real risk is when retail starts to sell. And Wilson said the S&P 500 could sink 20% in the likelihood of recession. Well, it could sink a whole lot more than that. We're not there, but things can change quickly, and so it's useful to know the downside in the bear case to manage one's risk. In the short term, however, Wilson said seasonal patterns bode well for earnings revisions as well as the S&P 500's performance. Nomura's Charlie McElligott sees lower odds of a market meltdown following controlled decline in the benchmark so far, but as of today, that's about to change in a major way because, again, if we start to see a lot of systematic selling, you're going to see panic in the markets, particularly as people start to realize that it's all about the labor market, and the risk here is the U.S. economy could head right into recession, maybe an all-out financial crisis if we continue to see people lose their jobs, particularly at the government level, and all that's going to do is backfeed into the broad economy. Now, amidst all this chaos, our subscribers are making money in this market, and you can too. Check out this trade. This was Hong Kong equities we put on the board back on February 13th. We told our subscribers to buy it open. As of the close of Friday, it's up 10.3%. Despite the massive meltdown in the NASDAQ and S&P 500, it's not down very much, meaning they're lining their pockets, and you can too. Now, how did we do it? We saw the momentum signals were rising, but we said, look, you've got to validate the trend. We made a massive update to our Momentum Timer Pro signals recently. We told them buy right here at the open, and now they're heading higher despite the meltdown in U.S. equities. And every day we run momentum screens across the broad equity, bond, currency, and commodity markets and across multiple time frames. And based on our algorithm, we look for opportunities in this market and we publish this to our subscribers. Now, you don't have to read the report. If you like the technical signals, if you want to know how we do it, you could follow the report, but you don't even have to do it. You get the daily report. We give you all the signals on the report, and then I break those trades down. I tell you, these are the ones you should take. We back tested it to know our report works. We give you risk control levels, a full weekly update on all our trades, including how I'm trading my own reports. And on top of that, we give you a 30-day free trial. That's right, your first month on me, but you've got to use the links in the description below and those coupon codes to grab that. And we're so confident that you can make money trading just like our subscribers. We want the first month to be on me. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.